Well, we're back, everybody. Mark Mousseau speaking. And in this section, what I want to talk about is the financial projection of this project. Anybody that wants to buy a real estate investment property, that wants to rent it, has to look at what their income will be, what their expenses will be, what their returns will be. So what I've done is what we have done, Bridgeport Development, is we prepared some financial projections that we will share with you, and we will actually at first give you our assumptions, and then we'll move towards the projections themselves. So this will be a mix of a Word document that you'll see, which is the document that starts up the financial projections, and then we'll go to an Excel spreadsheet, and you'll have three different documents. One of them is for the one-bedroom model A, two-bedroom model B, and three-bedroom model C, and you'll see how we came to calculate your income and expenses, and we'll give you some information on this. So without further delay, let's move to our financial projections. Okay, so here's the agreement per se, or at least the assumptions that we're using to get you to financial statement. So we'll review this first, as mentioned, financial projections, and based on this afterwards, we'll talk about the contract per se, the presentation by itself. So basically, what you have to know is that this is from the effective date for a period of 5 years. So regardless if we close in May, June, or July 2016, basically these projections are made for a period of 5 years from the effective date. What's naturally important to understand is the following. These projections are prepared by management. So they're prepared by us based on what we believe to be the most probable set of economic conditions. So we use hypotheses, des hypothèses, that are, in our judgment, pretty strong. We know what the rental market will be there. We have 20, 30 years, 30 and a few years of management experience and project experience. So we sort of had a very good idea, and you'll see in our projections that we've been we've been making sure that you're not going to be stuck with a bad investment, if I could say so, or a bad purchase. So we know what our numbers are all about. Naturally, there's some sort of disclaimer here. We're saying that, their objectives information, their hypotheses, they're designed to provide you with information, but it's a projection. That's what I could say. The assumption and hypothesis disclosed here are those that management believes are significant to the projection. Some assumption inevitably will not materialize themselves due to unanticipated circumstance. So we just know about it, and these are prepared as of September 15, 2015. Okay, hypothesis. Okay, we're basically bringing forward the fact that this is for a period of 5 years. And what we want to do is to give you a worry-free real estate acquisition opportunity for a period of 5 years. Okay, so first of all, regardless of the rental income that is generated by the property, Bridgeport will sign a lease with the purchaser for a period of time, and this lease will also have increases in it. So it's not only a matter we'll give you 19,800, we'll give you 19,008 for year one, and so on and so on, and you have that in detail in the financial projection and in your contracts. Okay, so this lease will actually be part of your closing documents once we move forward in transaction. We've also calculated the operating expense to go up by 3% per year. So we know that they will range between 2 to 4%. We've calculated them at 3% increases per year. Bridgeport will actually be making the mortgage payment. So you don't have to worry about, oh, I got to make my mortgage payment this month. We're collecting the rent, we're paying the bank directly, and it's actually one of their requirements in order to lend to an investor out of Canada or anywhere actually. We'll also be doing the same thing for property taxes. So we're paying your taxes for you. So there's no need to be worried about this. And let's talk about income tax here. Okay, so first of all, personal and corporate taxes. Bridgeport does not make any assumption, projection, or recommendation in regards to tax implication of buying real estate in the United States of America. So we're not giving you any advice here. And the reason I'm saying this is that we're basically saying, here's your property, you own the property, here's your income, and it's going to be backed by a lease. Here's what we project to be the expenses, and this will be your net cash flow. Each investor should consult their accountant for the deductibility of certain expense from your personal income or your corporate income. Now, some of these expenses would be interest borrowed to legally generate an income, and I say legally, it's a term used. In our case, Revenue Canada says that any money borrowed for the purpose of generating an income in real estate, the interest is tax deductible. You should talk to your accountant about depreciation of building, depreciation of appliances. We've included that in our packages. Okay. I'll just go back. The first mortgage loan, well, effectively 6.5% is what we calculated. 25-year term, 25-year amortization over a 5-year term. Same thing for secondary financing, which is the mortgage that Bridgeport Holding will hold on the property. This one is at 7.5%. And I've already mentioned a few times that management will be provided at a cost of 6% of the gross period for a period of 5 years. Now this is fixed. You are basically, this is a fixed expense. We will not increase our management fee more than that amount per year. So these are the assumptions. Now let's go towards the financial projection themselves, and we'll start with a one-bedroom Model A. Okay, we are on the, let's say, the technical aspect of the projections, or at least the math side of it. And what I want to do is I want to run with you how we prepared those projections. So condominium project is the residence, as you could see, one-bedroom model, unit Model A, one bedroom, 5 years from the commencing of the effective date. So anytime after we close, 5 years starts there, and we're doing right now basically year 1, 2, 3, 4, and 5. Okay, so the rental income as per the agreement. So effectively, your management contract and your offer to purchase will stipulate how much we will pay, what will be the lease that we will sign with the owner of the unit, and these are the amount on the one bedroom. So we'll pay, well, your lease total for year 1 will be in the amount of $19,800. So $1,650 a month, and it will go up month after month after month to a total of $21,360. And on the 5th year, you will get $1,780 in rental income. Okay, so that's the start. So the lease is signed with you for these amounts for the next 5 years. So what this does basically is it gives you a 0% vacancy. We're basically saying, hey, we're going to be your tenant regardless that there is a tenant in there or not. We will be your tenant. Okay, number one. Number two, we've calculated our taxes, and we've calculated them to increase. Same thing with insurance, repairs and maintenance. And you notice that we have quite a hefty chunk in repairs and maintenance, although it is new. What we want to make sure is that we will maintain those units to very high standards so people will be happy to rent from us and to live there. And also, naturally, when you have a higher turnaround than turnover, if I could say so, than a 1-year lease, because we'll have some 6-month leases, that's for sure, then there's more repairs to be made. So we've calculated these expenses to be hefty and there. Management fee, as mentioned, 6% of what? 6% of this amount, basically, and condo fees. So condo fees is the next line that is important here. Condo fees, basically, as I mentioned, we are capping the condo fees at these amounts per year for the next 5 years. So regardless of what the condominium fees will be, for other units, this is the maximum that will be charged to an investor or a purchaser for owning his unit. So what does that do? We get $19,008 in income. We have $8,000 worth of expenses. So basically it gives us rental income before principal and interest on debt financing, which is basically your net operating income to the purchaser. So your NOI will be, these are the amounts that your NOI will be. And if you notice here, what we've done is we've basically tried to maintain almost a 50% operating cost. And the reason I say almost 50% is that even if I have 43.25 here, notice that there is 0% vacancy because the lease is signed with us. So technically on a building, you calculate a 5, 6, 7% vacancy. So we've basically allocated for that in order to give you your number here, and it goes between 43 and 45% basically of your gross income, calculating all of your expenses. So your rent is leased, the lease is with us, your condo fees are capped out, and so basically the only thing that we have to work with or to look at is these fees here. Okay, so basically we get $11,000 in net operating income. Now we will be making the first mortgage payment, the second mortgage payment, and it's a principal and interest. So here's your interest on your first mortgage. Here's your interest on your second mortgage. So technically, by the way, these two amounts, which in this case equates to $6,378, this is interest to earn money. Again, speak with your accountant, but this is technically deductible on an income tax return. Again, I'm not giving you advice. I'm just telling you that check with your accountant, but this interest here is definitely, in my view, and I'm not telling you that that's the whole truth, nothing but the truth, but that's the reality of it. So that means that if I'm getting $11,000 in net operating income and I have these expenses here, my net cash flow, your net cash flow basically is $2,881 per year or $240 per month. Now, one of the questions that you have to ask yourself, how many of you have bought properties that are worth $150,000, a one unit, a one bedroom, and are cash flowing $250 a month in Toronto, Calgary, Vancouver, Hamilton, Saskatoon, Regina, Windsor? Where do you find properties that would cash flow on an investment of $150,000? And don't forget, this is US dollars. So people are telling me, Mark, we're investing in US dollars. Your income is in US dollars also. Your income, if you want, could stay in the United States. We don't care where the income goes. We're paying the income to your US corporation, and then you decide what transfers you want to do. So think about it. And those of you that know me as a trainer, I used to say, well, if you get $75 to $100 a month positive cash flow on a property, you made a good investment. So in a nutshell, you're making $250 a month positive cash flow on this property, and it goes up a little bit as we go by. Your net operating income goes up. Your expenses are even calculated to go up. Your rent is basically with the lease that we have working with you. So in this case, on this property here, if you look at the bottom here, technically, if I add the $15,000 in cash flow that we have here, so this is my cash flow, we agree? So I'm going to get $15,000 in cash flow. We'll be repaying principal payment, and that is $9,903. So we round it off to 10. And the appreciation on your property at a 3% appreciation compounded gives you about $24,000 in appreciation. So basically, if you add 15,000 plus 10,000 plus 24, it equates to what? Almost $50,000 over 5 years. And your investment, or what your down payment is required on this, is $45,000. So this property, this one bedroom unit, and is a great investment because we're getting such high rent, and this is due to the market that we have over there right now. Do you follow me, people? So if you have any question on that, please feel free to call me. Now, we'll also give you real estate indicators. Well, it's funny. Purchase price is $149.9. GRM, gross rent multiplier, is 7.57, a cap rate of 7.5, and the rule of 1%, it's $165,000, and you're paying $149. So you're paying less than the rule of 1%. And anywhere, Toronto, anywhere of the cities that I mentioned, you're paying 150 times it's a rule of 150, which means that nothing at all cash flows. So guys, these are the projections for your investment or your property. 1-bedroom unit, Model A, you should expect the cash flow about $250 a month or $3,000 a year. You've got some buffers there, 0% vacancy. Management is already established. It will not change. Your rental income is already signed on a 5-year lease, which means no vacancy, and your condo fees are capped off. So really, insurance, repairs, and maintenance are your two expenses that are important out here, and so on. So we'll talk to you on the 2-bedroom Model B, and I'll explain basically the same thing on that projection. Talk to you in a second.